Hello, everyone, and welcome. Thank you for attending the first panel of the day. It's still quite early, so thank you for waking up for this. I remember the first edition of the Stable Summit, which took place in Paris. And back then, when I told people that I was going to a stable conference, people thought that it was so boring and that I would just fall asleep during the various panels. Now, apparently, after years of struggle in trying to find a way for crypto to go mainstream, the only thing that makes sense is a coin that is worth $1 at all the times. So it's quite interesting because this panel has this summit has quite become the main topic today of the crypto world. And so before diving into the infrastructure, the payments, and all of this, I would just like to set the stage and talk about the current crypto landscape. So for years now, we have had two centralized actors that have been dominant in the crypto stablecoin space, which are Tether and Circle. And so with new stablecoins launching, we have new actors coming in, we have institutions, we have banks, we have Walmart, Revolut, Ripple, whatever. We're having a lot of new centralized and decentralized stablecoins coming in. And so the first question would be, do you expect Tether and Circle to remain the global actors that dominate the space? Or do you think they will start losing their market share and just fade away for some actors that are more established and less crypto native? Feel free to...
I can start if you want. So there's a lot of industry when you're the original leader, you take the lion's share of the industry. So it's really hard to say will it be the case here or not. Usually institutions, the overall thinking was USDT will not be the stablecoin the institution will be using. It doesn't mean that it won't have existing or new use cases for retail and remittances and kind of thing. What I could see in my seat, quick introduction. So I'm Charles Jansen. I'm the managing director for all digital asset at S&P Global, so the credit rating agency for index, S&P Dow Jones indices, commodity insight, and other divisions. We created a product a year and a half ago to look at the risk specifically of stablecoin, the risk of DPEG. And it was very interesting to see the kind of reception we got. Like it was bigger than what we thought in the sense that almost every bank, so you mentioned corporate, but it's really a global phenomenon right now. Every banks are looking at launching their own stablecoin. Some regions are looking at launching their own stablecoin. So while it's hard to say if, USDT and USDT will be the leader in 5 years, in 10 years, etc. What we can see is that there is a lot of competition coming. Then there is the competition to stablecoin. So in some countries you got the CBDCs, but also you have the JP Morgan deposit token that was announced. So I think it's going to be by use case. USDT will probably continue to lead where it's leading now, but the institutions and the amount of, technically potential hundreds of billions that come with them will probably go to somebody else.
Yeah, from my perspective, it's the question how we define the market and also at the stage of the market that we're in right now. Because I think if we look at the crypto industry, and I think we all know that in the crypto industry, the name players like Circle and Tether have almost the whole market under their control. But it's just the crypto market. And as many market participants also expect stablecoins to grow towards industries, kind of like let's call it in the normie world. So I think it's the question how the market distributions maybe in 2, in 5, and 10 years will be there. And there's another factor that I personally really believe in. So it's actually my theory that the closer we bring stablecoins to the masses, that local currencies will have a huge impact also on the distribution. So what does it mean? So we're located here in Europe. We have euro as the base currency when you go into a cafe or to the beach bar to get a drink. And especially people who earn their salaries in euro, they want to spend in euro as well. So therefore, I think there will also be some sort of redistribution again when. I can't say much about the time frame in 2 years, in 5 years, in 10 years. So where eventually also then local players can play an important role.
He and I were actually just talking about this off stage. There are some very large players that were previously looking to launch their own. Some of them ended up partnering with Circle. I don't think that long term that's sustainable. I think he mentioned deposit tokens. This is probably the next big wave. The stablecoin construction arguably has a structural limit in the sense that what percentage of Jamie Dimon's balance sheet do you think he's actually going to let these squid companies effectively control, right? Is it 0.1%, which it kind of is now, or less? Is it 1%? It's not going to be 10%. At 10%, he's going to say, you're basically, this 40-person company is extracting away from me my customer balance assets. And so what you're going to see is either there's going to be a regulatory pushback at some point, or, as we've already seen, the banks are going to rush in with their version, which is basically tokenizing their own deposits. And we've already seen it start with JP Morgan. I have meetings daily with banks on this, and I think that again, Charles really kind of framed it accurately. Like the whole world just kind of woke up when Circle went public. I was having daily meetings with banks in the 2 weeks after, and they were kind of slowly and then more aggressively kind of freaking out. So what I would say is, like, you're going to, it is definitely going to get much more interesting very quickly. I think it would be a bizarre moment in, kind of footnote in history if these two, decent but not exceptional companies that, that just happen to have a head start somehow end up, becoming the winner take most of, of representation of dollars. I will give you one scenario that I highlighted to two of the largest banks in the country that freaked them out. Going back to this, how big can the stablecoin construction actually become? The one way that it could become bigger is if, and I do expect both of them to apply, is if they try to become narrow banks, where they actually are able to hold direct liabilities of the Fed. Historically, the Federal Reserve has never wanted this for macroprudential stability reasons we won't go into, but I think there is a new Fed chairman coming in the next 12 to 18 months, and that it's not a given that we won't have a narrow bank construction emerge that would give a direct path for either Circle or Tether to take their strategy much more mainstream.
Hello. You're right on some long-term perspective, but I think from a short-term and mid-term perspective. From Société Générale Forge, we issued 2 stablecoins, so €1 and $1. And to be honest, to compete with Tether and Circle is really difficult. There's the network, there's the distributor, there's the liquidity premium. And even if you want to compete on other use case, like payment, because as we have a bank, we want to integrate our stablecoin in the legacy system of the bank. Also for settlement asset in terms of security settlement. So it is the kind of thing that we can add and we can compete with Tether or Circle. But at the end, you need to have a liquidity layer that is quite enough to bring the user and to make the ecosystem comfortable. And at this stage, and I don't have a crystal ball, but it would be very difficult to compete with these 2 stablecoin. It will get bigger and bigger, and they will have the resource and maybe the lobby to ensure that they will become regulatory compliance with the US, with the European, etc. So I think the competition will be quite interesting, but it will be difficult.
At least on Ethereum, where I'm a sole domain expert on Ethereum, as the ETH Max of Wall Street. Base rollups allow banks or any type of financial institution to have its own private permission execution environment that is synchronously composable against the Ethereum L1. You're going to hear much more about that next week at the Block Space Futures and the Base Rollup Day. But the innovation that has happened in Ethereum, where, just to be clear, 80+% of all stablecoins exist on Ethereum. I'm not sure that these interoperability layers or the Circle or Tether constructions are even going to be relevant in the future, to be honest.
Just for the sake of the debate. So I was interested by your point on euro. I spent more than around 15 years in Argentina, so I kind of really see the demand for US dollar that there are in other places. In the same stable summit in Singapore, I mentioned that I think some country can end up losing their currency. And since then, what has been very interesting that even country like the UK are now, there are conversations with central banks. There is a concern that there could be a dollarification of even big country like that, right? And we're not speaking of Venezuela, Zimbabwe, etc. We're speaking about even in the European Union. I think Christine Lagarde asked the country just recently to focus on stablecoin because, well, the US is launching this law, etc. So I think there is a case to be made that, well, stablecoin have been so far a tool for mass domination of the US dollar, and they could be it even more. Now, on the point that were mentioned on that side of the panel, there is one more consideration that can lead to, well, the very strong long-term success of stablecoin, and it's that US need a buyer for treasuries. So there's a whole conversation around, well, will the stablecoin be the biggest buyer of treasuries? Many, and I believe that it's likely, and then all the implications that come with that.
There is. I want to go back to what you said, Peter. You said it depends on what you want to compete on, and I think that Guy Young, who is the CEO of Ethena, made a really good point in one of his podcasts with Guart. He said that there are essentially 3 layers of competition for stablecoins today. The first one is trading. So on centralized venues such as, for example, Binance or Kraken or whatever, where most of the liquidity of stablecoins are today. It's essentially used for trading various pairs, and their USDT is dominant because it's the one that has the deepest liquidity. It's the one where there are the most volumes, and essentially today, as an exchange, you want to integrate USDT because most of the people have USDT. Then you have the payments. The payments infrastructure where today USDT is also dominant because when you look at the USDT distribution per blockchain, you have around 70 billion of USDT sitting on Tron, which is essentially not a compliant blockchain from what we can say about Dustin's Sun, but it's a really cheap blockchain, which is really fast and which has been historically used for stablecoin transactions. And when you listen to Paolo Arduino from Tether, he says that USDT on Tron is essentially used in countries like Argentina, in South America, or even in Africa. And then you have the yield. The yield where you have yield-bearing stablecoins where you still have some place where you some space where you could compete, where basically people would hold stablecoins to perceive yield on their dollars. So I think it's a nice thesis to summarize like the various areas where the stablecoins can compete today. And now let's go to the next topic. And I mentioned Tron before, and I think it's one of these points where the institutions have so far been quite reluctant to use USDT or use Tron because of the regulatory hurdles. Yes?
Most of the tether on Tron is there for a very specific reason that and is controlled by a few large individuals. So I don't think the prevailing narrative is actually accurate. I don't want to go into a lot of detail about it, but I think a few large Asian whales have financial arrangements that have resulted in them having that tether on Tron. I would also say, I can't confirm this because I haven't used Tron, but apparently the fees have actually gone up quite a bit recently. So I'm not sure that that previous take was actually accurate either.
Yeah, I'll add on that too. So I think it was Castle Island Capital that sent a report on stablecoin last year where they dived in this kind of use case and saw that actually Tron was not used that much for like in countries like Argentina. I personally never met anybody in Argentina using Tron. The big blockchain, at least 2 years ago when I left, was BSC, will be in BU right now. And it was USDT. So the way it works, just for the audience, is in those countries you don't get like, well, now it changed a bit, but You used to not have direct access to the US dollar, so you would go to a place which, well, they are everywhere, called black market, una cueva, and you will exchange your pesos for dollars. And then since 2020, you have almost half of them that give you access to stablecoin. It was always USDT on BSC and never so Tron. Just
so from also halfway also responding to your points. So like the use case that you called yield, I always call Treasury, and then I put these two use cases in there. So the one is earning yield, and the other one is, for example, countries like Argentina or Turkey who have unstable local currencies, so that they want to hold money in those currencies. But aligning it again with the timeline. So what is the market right now, and what is the market tomorrow? So I think also like what blockchain is used. Is it Tron? Is it Ethereum? Or is it someone else? Is it a layer 2? Really depends on the market distribution. So that's happening in those relevant markets. And so I at least have the perception that over the last 12 months, there's really a lot of startups also popping up, really trying to address, again, people who are not naturally in the crypto space and already know about stablecoins and about all that infrastructure, and eventually already have an own wallet and an exchange account and so on. So those companies are addressing the people who are not banked in the crypto world right now. And I think that's the major difference. So therefore, I think the cards can be mixed in a new way again. So especially when these startups and companies and eventually also banks and institutions really do a good job and onboard new people into crypto.
No, I just wanted to come back on the Tron issue, because I understand that all the Tron USDT holding is held by a big whale or this kind of entity. But at the same time, the Tether entity take it quite seriously, because they want to mitigate this risk of concentration by pushing plasma or this kind of new layer 1. So there is a risk, and I think it's not only well on Tron, and the remittance use case in Tron is quite real on that point.
Yeah, I think that's the topic I wanted to get in, because we are seeing now blockchains which are focused on stablecoins, like you mentioned, Plasma. We are seeing from Tether's perspective as well that they are deploying like USDT 0, for example, which is cross-chain compatible, which is quite similar to what Circle does with CCTP as well, where you can basically transfer stablecoins from one blockchain to another in a really easy way. And so the question I want to get to is, how do you perceive the role of various blockchains within the stablecoin space? Because today we have Ethereum, which is obviously dominant, and then we have Tron as well. And then all the other ones launching or stablecoins being deployed on other blockchains, do they actually matter? And in the long run, will we even know which blockchain we are using?
I think this is Tether's third blockchain now, right? I'm old enough to remember Omni. Then there was the EOS fork. I think they still run that one. I'm not sure.
I think they discontinued it recently.
Oh, that one too. Okay. So this is round 3 for them. Yeah, I think I'm not sure it's worthy of the time of the conversation, to be honest. I think I just wanted to throw that out there. The other thing a spicy take, which not exactly relevant, but getting back to Athena, I don't really think of that as a stable coin. It's more like high yield in a sense. It's a different type of risk. You're really taking kind of cascade risk and operational risk, just to kind of point out. But I'll let the rest of the panel address this question.
I would just in general say we should make sure that we don't end up with kind of like amount of developers in the blockchain area equals the amount of blockchains that we have for different use cases. So because that would be in particular bad. I think it's so right now let's call it we have blockchains that are multi-purpose. So in the end you have, like, for example, Ethereum, you do asset tokenization, you have like different kinds of assets, and in the end the use cases for those multi-usage blockchains are in the end now still emerging, and we still find new forms of usage for it, and therefore I think it's way too early for like specialization. I would say so. Like specialization might come, so especially if all the use cases that we're going to have for stablecoins in the future, if they really shape out and really find mass adoption, so then there might be enough scale for that. But I think right now, where you also use stablecoins for trading on a DEX, and if the DEX is sitting on public Ethereum or on the layer 2, you want to use the stablecoin there. So therefore, for the moment we're right now in, I think CCTP and those kind of native mint burn approaches are still the way to go.
So there is a channeling CCTP for like the cross-chain, etc. But there are some other interesting projects. I don't know if you heard of Ubix, for instance. They're creating this kind of place where banks can go and exchange a stablecoin for cash or any other stablecoin. Of course, here we're back to one of the topics I'm looking at the most, which is the risk. Like all stablecoin are targeting a peg, but they're not all made the same way, and they'll have different risk, which will affect, the yield they can get or how easily they can be redeemed in something like Ubix. But the goal will be probably, yes, to just be abstracted from that in some form. Now, there are hundreds of stablecoins being built. It's likely there'll be a consolidation at some point.
Just one quick comment on Ubix. So I think the game changer on that end is really streamlining the redemption processes and so on. So actually, I would say not the part that's happening on the blockchain, so which I think is already quite streamlined, but really managing what's going on when I swap from one stablecoin to another, and kind of all the off-chain stuff being handled. I think that's really the game changer.
Yeah, just one point on my side. So interoperability and all the cross-chain protocol is great, but at the end, for a stablecoin issuer, it's quite difficult to have so many layer 1, layer 2, and to be native to all this kind of blockchain. It's a lot of resource, and in terms of liquidity, you need to pay a lot also to be present in this kind of blockchain. And in the blockchain, you need to be present on some protocol. So it's not sustainable in terms of business case for stablecoin issuer, because you need to pay the market maker, you need to pay the distributor, you need to pay also the protocol in order to bootstrap the liquidity. To be honest, it's quite a nightmare to have it. So cross-chain protocol is nice, but I think at the end, it's like securities. You know, when in Europe particularly, you have a lot of custodian, so you have national custodian, local custodian, etc. And you do a lot of reconciliation, so you have a lot of settlement place. And now it's the same for this ecosystem, but not on the settlement thing, but on the execution thing. So I think it's not sustainable, and that's why at the end there will be just 1, 2, or 3 layer ones that will exist, because it's not sustainable. It's impossible.
Yeah, you touched on a really good point, which is fragmentation within the stablecoin space. So we have 2 types of fragmentation. The first fragmentation is between the blockchains, so which fragments the liquidity. And then you have the number of stablecoins which are available on the market. So from the standpoint of a user, for example, when I go to a store and I want to pay with my Apple Pay, I don't think which euro or which dollar I will be paying with. I know that it will be accepted anyway. When we look at stablecoins, so for example, I think the best example would be to take Walmart, which are working on their own stablecoin. It would make sense for Walmart to accept their stablecoin within their stores. But for example, if you are using USDC, for example, you would go to the store and it would not be accepted. So you would have to swap from USDC towards a Walmart USDC, and then have a wallet on your phone, which allows you to do that, and have Ethereum or whatever to pay fees to do this. And so with this type of fragmentation, do you think that we will still have stable coins that will be a marginal use case, for example, which will be kind of internal to some companies, to some organizations, which will be running only for them? Or do you think at some point we will have some unity within like this whole space where we'll have an abstraction of stablecoins that we can use and that could be accepted anywhere.
Okay, I can start. I think one of the use cases is loyalty points. That the kind of thing that makes the most sense to me. Like when you look at airlines or even Walmart, like do they really need their own stablecoin? For PayPal, it's different. You can see more the type of company and how they could use it. I'm not familiar with the detail of the Walmart stablecoin and how it would work and what was the goal, but I'm thinking loyalty for that type of use case. One thing I didn't say, all opinions are my own and not of my employer.
Yeah, so I also hope that the future of stablecoins is not like how things happened in the past with e-money. So kind of that you get stuck in kind of like local verticals that are not interoperable to each other. So where you only can spend money like in whatever at one shop and it's kind of close to move money over. And so therefore, I think the most important part is that so even if companies are going for their own stablecoin, so that they use the same technology as all the open projects, so kind of public permissionless, the best, so open standards, because then we can make sure that all the components that are also delivered from the industry, like wallets and custodians and everything else which is needed, is really also provided, and that's, I think, the foundation for interoperability. But if Walmart and whatever Zalando or whatever players are moving forward with their own stablecoins, I think at the stage of the market where we are right now, it would still help to reach mass adoption, because in the end it would bring stablecoins and the technology to more people. And I think that's kind of looking at the distribution, definitely something we should strive for.
Yeah, the same on the. I think it could be a kind of niche for Walmart or this kind of stablecoin issuer, just to play with stablecoin. But when you want to go in this business, you need to compete with the dominant stablecoin, and you need to push use case at scale and not just to pay for Walmart or this kind of stuff. So you need to be big, and at the end, stablecoin will be, I think, a kind of commodity. The margin will be like TradFi, where all the margin will be taken by as a distributor. So you need to have a kind of good cushion in terms of market cap to be sustainable in your business.
Yeah, as our panel is supposed to talk about institutions as well, I think it's important to mention some of the main things that institutions will be looking before going into a stablecoin, using a stablecoin, or deploying one. So what are the most important factors? Is it the blockchain that you're looking into? Is it the scalability, the fees, the redemption, the fiat counterpart that you will be using, the yield that you can have on the stablecoins? What are the most important factors for institutions today?
There are a lot of... we went through the business case step by step. So maybe the only advice at that time that we have is you try to get all the compliance stuff, validation internally as soon as possible, and you issue as soon as possible, because you don't want them to change their mind. So you push it on the blockchain, and after you try to make your product better in the time. And with that in mind, I think the main things for stablecoin issuer to make it happen and to go faster is to have a lot of partnership, a big distributor to focus on your area zone first. So if it is Europe, you need to have the big player in Europe. If it's compliance, of course, because we wanted to go through Binance, but it was really difficult at that time, to be honest. And you need to find a good partnership in order to distribute your product. And after, you cross your finger that they will accept other use cases like DeFi or this kind of stuff, because it's a nightmare we struggle with that. But yes, you need to go step by step, and you need not to be scared to deploy and to go forward.
Yeah, in my conversations, they don't really know. They're still just trying to figure it out, to be honest. Experiment. One bank said, we love Ethereum. We know that's kind of like where the long term is, but in the short term, we're going to play around on other blockchains too. I said, good, go play, experiment, have fun. Take their foundation money to help you, to pay to learn. But they just they don't know. A lot of them are taking a lot of meetings so that they can wrap their head around what's going on. They really don't know, to be honest. I'm being serious. A lot of them had not thought about this narrow bank situation. Were very concerned once I raised that fact. Circle already has applied once, so this is not a new thing. They applied, I think, a year or two ago and got rejected, of course. But when I raised this, they, because up until now, certainly before the election, they were dismissive of this everything. After the election, that has gradually changed. With Circle going public, there's a holy whatever, we have to figure out what's going on here. So they're in this learning phase. The idea of the network effective liquidity or whatever is not yet something that's fully embedded in their brains. Even some of the savviest players, he and I were talking about earlier, that have longer term master plans, they have in the short term traded off to work with the Circles of the world. But I can see them realizing that that's not a long-term solution and having to kind of pivot back. So again, even the savviest players are still trying to figure out what their long-term strategy is and what's important to them.
Yeah, I think you mentioned already quite a few points that are definitely relevant when doing a decision. So scalability, low fees, also governance model of the blockchains and so on, degree of decentralization. I think these aspects are important. But I think there's also, when it comes to institutional adoption, one important thing that I think also many institutions don't calculate in, and that's simply the fact that we're talking about a product here which is deeply rooted in crypto. And so most usage of stablecoins still is in crypto, also for DEX trading, for lending and yield, and everything that we're building here. Also many people of you, and in the end, also the money is earned in crypto. And so I think also when companies are managed in a, let's say, a normal way, so they're looking into, okay, what's the business case, where can I earn money, and so on. And once they start realizing, oh, I earn the money in crypto, so then potentially the project gets slower and doesn't move on as quickly anymore. So therefore, I think when going as an institution into the stablecoin market, you need to accept that so money and also kind of revenues are made in crypto. So the business model is around crypto, and when the long-term adoption comes, of course, so then and also all the use cases that you mentioned then really kick in. So then we move out of that crypto world and it becomes a normie world. But I think for at least a few years it will be crypto.
What we were lacking was really the regulation, at least the regulation in the US. The line between crypto and TradFi digital asset will blur. We'll already see that when we see what BlackRock's been doing, right? So we mentioned the IPO of Circle, but the interest in stablecoin, I think, started for many institutions. If my memory is right, it was 2022 when BlackRock invested directly in Circle. These had all the other more reactive, maybe, or not as involved asset manager really scared and interested in the field. If BlackRock is doing this, we should look at the field. Then, of course, you had the Beetle actual product, which is not the stablecoin, but shows how, well, they're not playing only in bringing Bitcoin and Ethereum to TradFi, is also bringing TradFi product and yield to DeFi. And so this line will continue to blur because one of the biggest topic right now is also vaults, and all the banks and fintechs are looking at that. So you start to get the yield from TradFi into DeFi, the yield of DeFi into TradFi, and then it's going to continue to blur more and more. But we'll touch on regulation, I think, in one of the next questions.
Yeah. We are getting there. Just before getting to the regulation part, I wanted to talk about the access that we have to stablecoins today. And when you look a few years back, accessing crypto, you could only do so through CEXes. And basically, you would deposit euros and get in exchange some cryptocurrency. So it can be stablecoins. I think ever since the on-ramp and off-ramp for crypto has quite been solved. In some way, it's way easier to access crypto when you look at wallets such as MetaMask or Phantom, for example. You can basically Apple Pay your way into getting some Solana and start trading. When you look at applications, for example, such as MoonPay, they offer a really easy access to that. When you look at CEXes, which are still present, you can look at Kraken and their onboarding, which has been great for users. And it's been one of the main venues to onboard and offboard your crypto because it's almost instant transfers with low fees. So do you think that the on-ramping and off-ramping still has some improvement to do? And do you think it has been solved, or can we do better?
I'll start first, but be fast. Yes, there's a lot of improvement to be done. I mean, MetaMask is not something that is easy to use for most people. If you've been in Ethereum for a very long time, yeah, you use it every day, or you use it for a very long time. But if you want people, I always take this use case, right? So in Argentina, you buy a house in dollar, in cash in Buenos Aires. You buy a car, you can do it in dollars. You don't buy a chocolate, right? You don't do your day-to-day life with that or with a stable coin. And the reason is, well, you don't have an easy way to do it. And the wallets out there today are nowhere near to the ease of use of Mercado Pago cash, or, like Uber Cash or whatever you call it. So there's a lot of improvement to be done.
Yeah, it's a lot of problem from my personal experience. Off-ramp on-ramp is an important feature for stablecoin issuer, especially for their authorized participants. So they need to sell euro against stablecoin and the opposite. But as a bank, we struggle to offer it during the weekend, for example. So there is a kind of stuff that we need to improve. It. And today, the best thing to do the off-ramp on-ramp is to go through a PSP or this kind of actor, but not directly on a wallet or other facilities like this.
I think the improvement that we need to do is that people are way more on-ramping than off-ramping. So the best would be that off-ramps wouldn't be needed, right? So because stablecoins would always stay in circulation or are maybe matched against each other, and the rest is happening in the background or maybe between the institutional or non-institutional players who are issuing the stablecoin. But yeah, so I think as long as and I think I still always hear these horror stories of people who cash out of the crypto ecosystem and their banks close the accounts and all this kind of stuff is still happening. So therefore, I think the on-ramp might be solved, but the off-ramp, I think, still remains a problem.
Yeah, I agree. MetaMask is terrible. I stopped using it. I actually have kind of a slightly different take on this, and actually where some upcoming announcements that we'll be making about some of the things I'll be leaning in on. But I actually think it may not matter. I think stablecoins may simply be used for net settling at the bank level. If you look at the transaction flow of how, say, a company like Stripe has to net settle between its major financial partners internationally and even domestically, it can take many days for them to complete a transaction, say, for a U.S. customer of Wells Fargo transacting in Japan or another country. And if it's in an emerging market, even longer than 4 or 5 days, much longer. And so that's where you can see this huge unlock of stablecoins simply being used at a wholesale level to solve, frankly, the fragmentation that happens in the back end. So if I was asking these guys earlier, have you ever heard of Herstat risk? Which is I encourage all of you to look up, but this is a multi-trillion-dollar problem in the global financial system that Ethereum can fix today by having robust, near CBDC or, sound deposit token or even commercial stablecoins that allow banks to net settle in near real time rather than 24-hour or multi-day cycles. So you may be using your Apple Pay to do a debit transaction in dollars, but on the back end, the banks or fintechs are using stablecoins to net settle that. So I'm going to be working with financial institutions and presenting this story more comprehensively in the coming months and years. But that is where I see the space maturing.
Just to add one more thing to, or one more aspect to what I just said before, because also if stablecoins in the future are used in a way that you get a stablecoin, you do a transaction, and then like a redemption happens on the other side, I think we don't win anything, because in the end, so we're definitely also not as cost effective as anyone claims that stablecoins are. I think stablecoins are going to be very cost effective if they stay in circulation. Kind of, you do a transaction, maybe like a trading firm does a transaction. Some people like abroad are paid, then they put it into yields on chain. Then kind of the protocol uses it at the next step, and then kind of we have these, of course, like cascades that we're going to create. But in the end, that's kind of where the value is and where the productivity of the money is.
And on the payment side, as you mentioned, we meet a lot of demand to meet our stablecoin, our dollar stablecoin in euro, in order to send the dollar stablecoin on cross-border. And when you can pay with the stablecoin, so you can fix this cross-border payment thing, and it's a huge market, to be honest.
Multi-trillion.
Yeah. And that's why to have a range of currency as stablecoin could be good things for a stablecoin issuer to compete with other stablecoins.
So here's a little alpha for the builders in the room.
Alpha, yes.
We can't end without a little bit of alpha. The one multi-bank, multinational solution that was presented in 2002 to the bank's problem of this FX settlement is called CLS. You can look it up, a continuous link settlement, but it only solves this problem for 18 currencies. Just to put that in context, no currency in Latin America is covered by CLS. And so, this is a global problem with a lot of different currencies. You're going to have we need people in every country basically having stable coins in their local denominations to help solve this problem.
Perfect. And to end this panel, I would just like to talk a little bit about regulation, because we have two major changes both in Europe and the US, which are coming up. So in the US, we have the Genius Act, and in Europe, we have the MiCA regulation. So what are your thoughts on the implementation of stablecoins? I know the MiCA one has been quite controversial because of the yield, especially. And then the Genius Act is supposed to bring the stablecoins to everyone in the US and allow institutions to use stablecoins as they please. So what are your thoughts on this, and do you think it will push the stablecoin adoption even forward?
Yes. So there's a before and there's an after, right? Especially with the US. Just for companies in the field, I speak with many. 3 are moving to the US because of that. We need to remember that it's a field where the US were working really against us. They were behind in regulation, but you had an administration in general which was really not helpful. Now there is a tailwind, and the regulation is changing a lot of things. Just the fact that the regulation was discussed had many banks look, even more banks, because when I mentioned we launched a product, it was mostly banking outside of the US that were looking at stablecoin stuff. So it will have a huge impact, and then there is a clarity bill also coming. So the US will become a leader in the stablecoin world, and probably more than with the like of DeFi and digital asset. MiCA, yes, there's some, like, you really feel that they don't like stablecoin that much when you see the restrictions that were put in place. And they've been released a bit, but you have a limit on the amount of transaction you can do, the amount of money that can be transacted in a day. So then they change it, I think, only for non-euro stablecoin. But yeah.
Yeah, so I think in general, I would also agree regulation helps to get more users into the space, because in the end, the people who want to use an unregulated stablecoin, or also like in the crypto world, I think anyone can do. So it's open to anyone globally. So the maybe institutions that want to use a regulated one, so they can choose a regulated one. So therefore, it brings more users to the space. I think the only exclamation mark we need to give here is kind of, especially when we have regulation popping up in different jurisdictions, it somehow needs to be compatible to each other, because we already see kind of like a patchwork regulation popping up. So, for example, in the EU with the MiCA, it's called the multi-issuer problem. So when Circle has like USDC being minted from a European entity and from a US entity, or like from an entity from a different jurisdiction, technically the token is the same, but as a user you have different redemption rights. For example, in the EU you have a right for redemption, it needs to be free and so on. So there's this like arbitrage that you then even can use, like when you're a US user and then kind of like being applied or having European law applied to you. So this makes it really complicated. And I must admit that I don't have a proper solution for that right now, but I think we really need to take care for those ones, because we want to have an interoperable means of payment, and we will only achieve it when also the regulations that are coming up are halfway aligned to each other, so that interchangeability and fungibility is guaranteed.
To finish off this panel, I just want to ask you each one of you to give one sentence to respond to this question. So we've had multiple narratives throughout the years in the crypto space. So we've had DeFi, we've had NFTs, we've had the metaverse. Still, right now, the global consensus, and that's how I started this panel, is that the stablecoins will be the most adopted thing within crypto. Why do you think the stablecoins stuck more within the crypto space, and why do you think it is the case today? So it's one sentence, just an easy one to finish off.
I will start by in one sentence. It touches everyday life. So you can pay with stablecoin for everything. So it's appealing for customer, and it would be appealing for institution if it's not only a payment but also a treasury asset. It would be nice.
The existing old system was so bad that the new one was, sufficiently better. And to restate the question, the killer app of blockchains is the movement of capital.
So I think this perception of everything you mentioned is really because they already exist. They're already a successful use case of tokenization of cash. But it's hard to say if it's going to be the biggest. And there's a lot of other tokenization happening that will happen.
Yeah, I also disagree to your question a bit, because so there's a huge hype topic which is called reward assets in crypto right now, and to me, stablecoins are the first reward asset that will hit the masses.
Thank you very much. Give it up for the speakers, and on to the next panel.